Now let's switch to the U.S. and check how Wall Street did overnight. U.S. stocks rose as better than estimated consumer confidence and home prices boosted optimism the recession is ending. Here are the closing numbers for the Dow, S&P 500 and the Nasdaq. The S&P has advanced 5 straight months and in 5 of the past 6 weeks. Checking how U.S. markets may open later today, futures. Let's take a look at where futures are. They're pointing to a pretty much mixed open, though the Nasdaq is currently unchanged. Now, amid numerous upbeat economic indicators, there are still plenty of pundits forecasting a reversal in the stock market rally this year. That's particularly if we look at the types of stocks leading the gains. Michelle McCory explains. Michelle.
Well, Huss, so much for the strongest leading the pack. In fact, when it comes to the S&P, it is the weakest. U.S. companies with the worst finances are beating the Standard & Poor's 500 index, even as their funding deteriorates. And that is a sign that their rally may soon end. Armstrong Investment Managers used what is known as the Z-score method to establish a company's financial stability. Now, the Z-score method measures the likelihood of insolvency by evaluating earnings, assets, and capitals, and companies with a low Z-score, that's less than 1.81, are considered to be at the greatest risk of failure. And Huss, it's those low Z-score companies, those with weak financial fundamentals, that have been leading the S&P rally. In fact, they've surged 90% since March 9th. Take a look at the chart coming up on the screen. As you can see, the red line there, that is the weakest non-financial companies in the S&P 500. And you can see they surged 90% since March 9th through last week. The green line, companies with the best finances, they've gained 49%. And the middle line there, the light blue line, is the S&P 500. So Patrick Armstrong, who's the founder of Armstrong Investment, says that this move in what he calls at-risk companies, those low Z-score companies, has now run its course, and they're now pricing in a strong recovery, which may or may not materialize. He says that if you see anything close to a W shape in the economic recovery, those companies at risk will fall and will fall hard. And lately there's been a lot of talk about a double-dip recession. Just yesterday we heard from Roubini, and he says a double-dip is in fact likely because of risks related to ending global monetary and fiscal stimulus. So that doesn't really bode well for that rally, Huss.
And of course, Roubini is not the only one. He has some supporters in that view. Michelle McCory, thank you so much for that.